Hello viewers, so welcome to my channel. I'm Hasham Ali Khan. Now I'm going to start unit number 2 in the subject accounting standards. The last unit number 1, 4 videos I have completed. The first video regarding the meaning of accounting standard, objective advantages and limitations in the first video. Second video, what is the process of formulation of accounting standards? What are the complete steps required in formulating the accounting standards? Then I have explained about the list of accounting standards issued by ASB. And last, fourth video, I have explained about the need for conversion of Indian accounting standard with the IFRS. What are the benefits of this conversion? So all these things I have already explained in the first unit. Now I'm going to start unit number 2. In this unit, a number of accounting standards I'm going to explain. First of all, in this video, accounting standard 1, that is disclosure of accounting policies, that I'm going to explain in the complete video. In examination, you will be asked, explain accounting standard 1, disclosure of accounting policies. Then you have to write all these points. I have written the important points on the board and I'll explain each and every point in detail. So watch the video till the end. Don't skip in between. Have some patience. If you watch the video with full concentration, with full interest, then definitely you can get a lot of command on this topic of accounting standards. Take the screenshot of the points which I have written on the board, then I'll explain all the points. Now, AS1, Accounting Standard 1. The title of this accounting standard is Disclosure of Accounting Policies. What are the accounting policies? First of all, we'll discuss. What do you mean by accounting policies? AS1 deals with disclosure of accounting policies followed in preparing and presenting the financial statements. While preparing the financial statements, a number of policies, principles have to be adopted. Then what are the policies, principles adopted in preparing the financial statement? That should be disclosed. If they are not disclosed, the user cannot be able to understand on what basis the financial statements are prepared. That is the purpose of this AS1. Now, accounting policies. What is the meaning of the term accounting policy? Accounting policy refers to the specific accounting principles adopted by the enterprise and the methods of applying those principles in the preparation and presentation of financial statements. The first line I have given the meaning of the term accounting policy. Accounting policy are the specific accounting principles which are adopted by an enterprise while preparing and presenting the financial statement. Those accounting principles are called accounting policies. Now, disclosure of accounting policy are important as different accounting policy can result in different amount being presented in the financial statements. So different policies will give different amounts. When different amounts are taken in the financial statements, the income, the profitability, the position will change. That means the values in financial statements depends on the treatment of the accounting policy. Which accounting policy we have applied, on that basis the amount will depend. Next, also different organizations may follow different policies and comparison of financial statements of two organizations will not be meaningful. See here, we don't have a single one method of accounting policy. We have different methods of accounting policy. Some follows one method, the other business will follow another method. So when different businesses follow different accounting policies, then definitely the financial statements will show different amounts. Then what will happen? We cannot be able to make the comparison. Comparison will be different, will be difficult because different organizations are following different policies. Then is clearly by the user. Accounting policies are normally disclosed in notes to the accounts. Whenever we prepare the financial statements, we should have some notes. In those notes to final accounts, in those notes we have to specify what are the accounting policies we have adopted while preparing the financial statements. These are the basic points you have to write. Next one is purpose. Why this accounting standard 1, disclosure of accounting policies, is made? What is the purpose? The first purpose is to promote better understanding of the financial statements. So when we clearly disclose what accounting policy we have adopted, then understandability of financial statement will increase. The user of financial statement can easily understand the financial statements if he is provided the method, the policies. Then secondly, to facilitate meaningful comparison of the financial statements of different organizations. Nowadays, in order to check whether our business is going better or not, we have to compare our performance with the competitor's performance, the other organization's performance. The comparison is possible only when both the businesses follow the same method of accounting or same accounting policies. Simple example, if you want to compare the height of two persons, both should stand on the same platform. If one person is standing on the ground and another person is standing on the chair, can we be able to prudently compare the height? No, because both are not standing on the same ground. Similarly, when we compare two organizations' performance, both organizations must follow the same accounting policies. So to facilitate comparison, we need to disclosure of accounting policies. So these two are the purpose. Now, fundamental accounting assumptions. Some accounting assumptions are there which are fundamental, basic. Every business organization must follow those fundamental accounting assumptions. What are those? Now I'm going to explain. Certain fundamental accounting assumptions underlie the preparation and presentation of financial statements. Whichever organization, whenever they make the financial statements, they have to follow some basic fundamental accounting assumption. Every business organization must follow those assumptions, and they are usually not stated because their acceptance and usage are assumed. These fundamental accounting assumptions need not be disclosed. The business should not declare that we are following this fundamental accounting assumption. No. It is assumed that every business is following certain fundamental accounting assumption. If it is not following, then it has to specify that our business is not following the fundamental accounting assumption. If following, no need of disclosure, because accounting standard 1 requires that an organization which is not following this assumption must disclose the fact to all its stakeholders. If they are not following, then only it has to disclose. Otherwise, if the organizations are following, no need to declare. So what are those fundamental accounting assumptions? There are 3 fundamental accounting assumptions. They are going concern, consistency, and accrual. These 3 are called fundamental accounting assumptions which every enterprise will follow, and it is not required to be disclosed. It is understood, assumed. First one, going concern concept. According to going concern concept, the accounting should imagine, should assume that this business is going to continue for a long period of time. There is neither the necessity nor the intention of the owner to stop the business. The business is not going to be stopped in the very near future. The business is going to continue for a long period of time. That is the assumption. On that assumption only, the accounting is made. Secondly, consistency. Consistency means uniformity. Whatever accounting methods, practices we are following, the same method should be continued from one year to another year. Every year the accounting method should not be changed. Once a method is adopted, the same method should be continued. That is consistency. If the method is changed, then disclosure is required. Accrual. According to accrual concept, all the incomes and expenditure relating to the current period should be taken, whether the income is received or not, whether the expenditure is paid or not. All the incomes and expenditure relating to the current year only should be considered. For that purpose only, any outstanding or prepaid should be adjusted. The outstanding expenditure should be added. Similarly, the prepaid expenditure should be deducted. Outstanding income should be added. Income received in advance should be deducted. So all these adjustments we are making because we have to follow accrual system. So these three are called fundamental accounting assumptions. Now, nature of accounting policies. So accounting policy refer to the specific accounting principles and methods of those principles adopted by the enterprise in the preparation and presentation of financial statements. Already in the beginning I told you about the meaning of the term accounting policy. It refers to specific accounting principles which are adopted by an enterprise while preparing and presenting the financial statements. Now, there is no single list of accounting policy which are applicable in all circumstances. Remember, there is no exhaustive list of all the accounting policy. We have innumerable accounting policies. Now, the accounting policy depends on the circumstances, on the nature of the business, on the nature of the transactions. Then this is because different organizations operate in different situations. The nature of business is different. The method of running the business is different. So we cannot say the same accounting policy will be adopted by every business organization. Simply we can say a doctor cannot prescribe the same medicine for every patient because every patient is different one. The nature of disease of every patient is different. So how the doctor can be able to prescribe the same medicine? No, it differs. Same is the case with accounting policy. The nature of the business is different. The nature of the transaction is different. So we have innumerable accounting policies. Now, it is the responsibility of the management to select an appropriate accounting policy. Ultimately, it depends on the management to select an appropriate accounting policy for our business. Now, some of the examples were different accounting policies. Now, what are the areas or what are the transactions on which we have different accounting policies? First example is method of depreciation. You might be knowing that depreciation we have different methods called straight line method, diminishing balance method, annuity method, sinking fund method, sum of digits number method, and machine hour rate method, revaluation method. Different methods of depreciation are there. So we cannot say always straight line method is good or always diminishing balance method is good. No, it depends on the nature of the business. So we have different options available for valuation, for methods of depreciation. Similarly, valuation of inventories. We can value the inventory at cost basis or market value basis or whichever is lower basis. So different methods of accounting are there for valuation of inventory. Similarly, valuation of goodwill. How to calculate the goodwill of a business? We have different methods: average price method, super price method, capitalization method. So many methods are there. Every method will give you a different amount of goodwill. Next one is valuation of investments. Then valuation of fixed assets, treatment of contingent liabilities. Few examples I have given where we don't have a single method. We have different types of method. The business has to select, the management has to select any one of the method of accounting, and same method should consistently be adopted every year. That's all. Now, factors influencing selection of accounting policy. Just now I told you the management is responsible for selecting an appropriate accounting policy. Now, on what basis he has to select? It does not depend on the will of the management. Some factors should be considered while selecting the accounting policy. So what are the factors? First of all, the primary consideration in selection of accounting policy should be to prepare and present financial statement in such a way that they represent a true and fair view of the state of affairs of the enterprise. The only thing to be remembered by the management is, while selecting the accounting policy, the policy should be such that the financial statements should show the true and fair view of the state of affairs of the business. That means the financial statement consists of profit and loss account. The profit and loss account should show the true profit earned during the year. Similarly, the statement of financial position, that is called balance sheet. The balance sheet must show the true financial position as on the last date. So, keeping in mind that the financial statement should show the true and fair view, we have to select an appropriate accounting policy. The management of each enterprise must select appropriate accounting policy, keeping in view of the three major considerations. Three major considerations the management must keep in view. Considering these three factors, then only we have to select an appropriate accounting policy. What is the first factor? The first factor is prudence. The meaning of prudence is record all expected losses, but don't record any expected gain. The accountant should be prudent in recognizing the income and expenditure. The profit should not be overstated, neither the profit should be understated. That means all expected losses and expenses should be recorded, but any expected gain should not be recorded. That is according to prudence. Next, second one is substance over form. This is the second consideration to be kept in mind by the management in selecting an appropriate accounting policy. Substance over form. The accounting treatment and presentation of transaction and event should be governed by the substance and not merely by the legal form. That means while deciding which policy we are to adopt, the management must go into the substance of the transaction. The management simply should not depend on merely the form, legal form. Third, materiality. Financial statements should disclose all material items separately. It should not be clubbed with any other item. Simply, all significant items or material items should be separately disclosed. So these three considerations the management must take into account while deciding the accounting policy. First one, prudence. Second, substance over form. And third one is materiality. That's it. Now next thing is disclosure of accounting policy. The last topic of this video in this AS1 is the disclosure of accounting policy. The final rules for disclosure of accounting policy. First one, all significant accounting policy adopted in the preparation of financial statements should be disclosed. First point. In examination, you must write these final points, these 6 points. The first final point, all significant accounting policies adopted by the enterprise in preparing the financial statement should be disclosed. Should be disclosed in the notes. Secondly, such disclosure should be part of financial statements. That means whatever disclosure you are making in the notes, that note should be a part of the financial statements. Thirdly, they should be disclosed at one place. All the accounting policies should be placed at one point. It should not be scattered. Then any change in the accounting policy which has a material effect in the current period or which is expected to have a material effect in later period should be disclosed. If a business is required to change the accounting policy, that means the circumstances are such that the management has to change it. Then what this AS1 says, AS1 says if a business wants to change the accounting policy, then what would be the impact of this change on the income of the current year, or what it will have the change in the future expected future years. What is the effect of the change in the accounting policy? The next fifth point is the impact of the change in policy cannot be ascertained if the impact of the change in accounting policy cannot be ascertained. It cannot be ascertained. Then in that case, a fact should be given that the impact of the change is unascertainable. It cannot be ascertained. That fact should be written in the disclosure. Then last one, if the fundamental accounting assumption, namely going concern, consistency and accrual, are followed in financial statements, specific disclosure is not required. If they are not followed, then disclosure is required. Certain fundamental accounting assumptions like going concern, consistency and accrual. These three fundamental accounting assumptions, if it is followed, no need to disclose. No need to write that we are following going concern, we are following consistency, we are following accrual. No need to disclose. If a business is not following those fundamental accounting assumptions, then it has to be disclosed. That's all. So I have explained all the points regarding AS1, Accounting Standard 1, disclosure of accounting policy. In the next video, I'll start the next accounting standard, that is Accounting Standard